Hello, class. Today we're going to continue on with the problems from chapter 4, the sample problems. Problem number 3 is one that I probably don't actually have to walk through with you. I'm just going to show you really quick here. Out on slide 36 in the PowerPoints is a walkthrough of the accounting cycle. So we see here, number 1, start with the beginning account balances. And next, we analyze and journalize transactions in the journal. And it's just walking through these steps that are out on 36. So I'm not going to take like 10 minutes to walk through this because hopefully you have been keeping up with the readings and are already familiar with this process. So it's just a matter of following through here with, okay, so we're beginning our account balances. We're analyzing and journalizing the transactions as they occur, posting entries to the accounts, preparing the adjusted trial balances, preparing the unadjusted trial balance. Let's see, where are we here? Oh, there we go. Analyzing, journalizing. Oh my goodness. Okay. Here we go. There we go. There it is. Compute the unadjusted balance in account, prepare the unadjusted trial balance, journalize and post the adjusting entries, preparing the adjusted trial balance. Let's see. There we go. Preparing the financial statements, journalizing and posting closing entries. There. Let's see. Looking for closing entries. There we go, way up at the top. Step 9, preparing the post-closing trial balance. And step 10 is going to be, well, actually step 10 isn't on this one. So we'll scroll down, but let's see here. Oh, we skipped entering the adjusted trial balance on the worksheet. So hold on a second here. Let's go back here. So computing the unadjusted balance in each account. Next, the optional step, which would have been up here. So I'm just going to shift these down, preparing that post-closing trial balance, journalize and post the closing entries, prepare the financial statements, got in a hurry there, prepare the adjusted trial balance, and journalize and post adjusting entries. So the optional step here is enter the unadjusted trial balance on the worksheet and complete the worksheet. That's a step that we'll actually be walking through here during this chapter. And it's mostly a worksheet, right? So it helps you to put together your unadjusted trial balance and walk through the posting of entries to reach your adjusted trial balance. So that is problem number 2. So the next thing we're going to do is actually walk through that process here by walking through a worksheet. Okay, so we have here an unadjusted trial balance, which is entered in on here. And then they are going to give us a list of adjusting entries that need to be made. Now, we walked through how to do these adjusting entries in chapter 3. So we already know how to make the entries, but we're going to look at what this looks like in a worksheet format here. So we have 5 entries here to make, and we need to know both sides of these entries in order to complete these. So I will kind of walk through that process here with I'm going to make this a little narrower here so that I can fit an Excel worksheet here. And and show you the journal entries we would be making as a little bit of review as I am walking through the worksheet here. All right, so putting this off to the side where we can actually see it here, we're going to want to know the entry. We're going to know the account, and we're going to need to know if it's a debit or a credit. Okay. So looking at this, for entry A here, we've got unearned revenue that was earned during the year for $800. So that means that we are going to be recording a liability for this unearned revenue. So in other words, or actually they already recorded the unearned revenue, and we are earning that revenue. So when this was originally recorded, they would have debited cash and credited their unearned revenue liability account. So we would have sitting out there a T account, which I'm going to just draw what that would look like for you. So they would have had sitting out there, we've got $5,500 that was sitting in unearned revenue at the beginning of the year. And then they earned 800 of that. So we need to reduce this balance down to reflect that it's $800 smaller. So we would debit that, and then that would get us 5,500 minus 800, which would be 4,700 for that unearned revenue. So when we make that entry, though, what we're going to do is we're going to debit unearned revenue for the 800, and then we are going to credit revenue, so service revenue, which would be, this is an income statement account. And so once we have that, we know here that these are the two parts that we need to enter here for A. So we're going to go to here, we're going to select A, we're going to put that 800 in there, and then we're going to go down to service revenue down here and put the credit side. All right. So that's our first entry. Now, our next entry that we're going to do here is office supplies on hand were 4,500. So that's the ending balance that we need to get to for the office supplies. Okay. So right now, we currently have 7,000 in here. And where we need to be is 4,500. So in order to get from here to there, the difference, 7,000 minus 4,500, is going to be 2,500 that we need to adjust here. Okay. So with knowing that, we are going to end up, when we remove these out of here, this line is going to be the credit, right? Because we did that on the right-hand side. So what are we going to debit for $2,500? That's going to be our supplies expense. All right. So next we're going to record that. We're going to credit this for the, oops, I don't know why it's saving that. Saying, oh, we did this before in class, actually. So crediting that for $2,500, and then scrolling down here to supplies expense, we're going to get that, and that's going to be B. All right. Now, for entry C here, depreciation for the year needs to be recorded $4,500. So we're going to debit the expense, the depreciation expense for that $4,500. And then what are we going to credit? That's going to be our accumulated depreciation. That's going to be, that's that contra asset account that's on our balance sheet. Let me go back to my slides here for a second and find that. Let me clear my writing. See if I can find a classified balance sheet to show you here really quick. There we go. So on here, We show our buildings, less accumulated depreciation building here. Down we've got furniture, less accumulated depreciation. So this pile of accumulated depreciation is a credit balance that offsets the price that we originally paid for that furniture, which was $18,000, minus $300 worth of depreciation that's been taken over the life of this asset, to give us our net book value of $17,700. So we need to credit accumulated depreciation here. So going back to our accounts here, crediting that account. So we're going to go up here, credit accumulated depreciation. We only have one account here, so it's got to be that one. And that's going to be entry C. So we have that credit part. Now we need to do the debit, which will be in depreciation expense here. All right, so we've got that. Now for entry D, we're going to accrue salaries expense. So from earlier chapters, we know that that means that we had people who did work for us and we have not yet paid them, but we need to record that we owe some people some salaries on our financial statement because we haven't paid them yet. So again, all of our expenses, when we record them, get debited, because every one of these adjusting journal entries usually hits an expense account or a revenue account, and then usually an asset or a liability. Okay. And generally not cash, right? Because the cash happened prior to these adjusting entries. So we're debiting our salaries expense for $5,000, and we are crediting our accrued service. Oh, sorry, our accrued salaries. Okay. Or salaries payable. Okay, so with that, let's go out here. Okay, so salaries payable is what they've got it under for 5,000, and that's entry D. And then we're going to get our salaries expense there. And again, if I'm going through this and you don't know what I'm talking about, please go back and watch those MyLab lecture videos because they walk through and explain this. This section that we're doing here would be under how could a worksheet help in preparing financial statements in the videos that we have out there. Okay. So now our last entry, accruing service revenue. So last time we accrued an expense, which is a debit. We're going to accrue a revenue on here, which is a credit. So just remembering that dealer acronym that, let me grab this. So dealer, D-E-A, the word dealer with a little line in the middle, L-E-R, tells us whether things are a debit normal balance or a credit normal balance, with dividends or withdrawals being the D, expenses being the first E, assets being the A. On the credit side, the ones that increase by crediting as a normal balance, so liabilities, equity, and revenue. So included under equity, that would be things that increase that would be credited would be owner capital and owner capital and revenues actually fall under here. Now, so owner capital increases equity, and then owner withdrawals are the opposite. They decrease equity, so they would be a debit balance. So that's this one right here, dividends. Okay. Just wanted to do a quick recap on that. All right. Going back to our problem though, so I had service revenue here, which we are crediting for 6,500, and accruing that revenue, we're going to have an account receivable. So we performed some services for somebody, and They did not pay us yet, so they owe us. All right, so next we're going to go up here. We're going to get this in here for 6,500 and then get our service revenue down here. Another, so there's two lines here, by the way, so don't write over the other line. All right, so that gets us there. And then we need to add up all of these columns to make sure we've got the total correct here. So I'm just gonna put this where I can see it. So 6,500 plus 800 plus 5,000 plus, scrolling down here, 2,500 plus 4,500 gets me 19,300 in debits. So theoretically, if I didn't forget to enter any of these in here, I should have both of those. So let's add the other side just to check. 2,500, 4,500, 5,000, 800, 6,500, 19,300. All right, so we're good there. Oops, and I forgot one little entry here, label. There we go. Okay, now the next section of our worksheet is the adjusted trial balance. So again, anything where there's no entry just gets carried over. And anything where there is an entry, debit plus a debit equals a bigger debit. A debit and a credit would be treated like a negative. So you'd say debit minus any credit entries if that was the case. A credit plus a credit equals a bigger credit, and a debit will offset a credit also. So here, 51,000 plus 6,500 gets me 57,500. Stop that now. 7,000 minus, so this is a debit and this is a credit. So this is going to offset this. So 7,000 minus 2,500 is going to get me the $4,500 balance that I wanted to have that we talked about earlier. So this is going to be 28,000. So here we've got two credits, 9,000 and 4,500. So those will add together. So by the way, I hope you're pausing this now and get the idea and do the rest of this yourself and then use mine to double check your answers so that you're actually getting practice learning how to do this, not just watching the video. So go ahead and pause right now and then do the rest of them on your own now that we've walked through how to do these. So I will walk through the service revenue one. We've got two credits here. So 93,000 plus 6,500 plus 800. So 100,300 here. Okay. So here, no entry, so that's a credit. This has only an entry with no beginning balance. This one has a credit balance that was debited. So 5,500 minus 800 would get us 4,700. And then, oops, sorry, credit balance, got that in the wrong column there. Then we've got credit balance here, credit balance here, and a debit balance here. Okay, those were part of this entry, so that's good. All right, so debit again. Oops, 40,000 plus 5,000. And then just the entry, 5,000 plus 0 or 5,500. 5,000 plus 0. And an entry for 4,500. So now we're going to go ahead and add these columns up again the same way that we did. And hopefully we end up with the same balances in each column. So scrolling down here to 29,000. So 114,000. And we're going to add up the other side. Well, let's just test it out. If we did not get it, if we did not add, if we missed any of these, then it'll tell us, right? Okay, so we're good. If I was on an exam though, I would definitely add this up first and check it myself before hitting submit so that you have it, you double check it. Okay, so we don't need to do any other math really. Now at this point, we've got an income statement column and a balance sheet column. So we just need to figure out, okay, which of these go into which columns, right? So we remember we've got the balance sheet covers the basic accounts that are in our assets equals liability and equity. So those account types will be on our balance sheet. And then on the income statement, we only have the temporary accounts, right? The accounts that get closed out every financial statement period, which are the revenue and expense accounts. So this just helps us keep track of on this worksheet which accounts are going to go on which financial statement. So let's start, since we start with the balance sheet accounts at the top of our trial balance, let's do those first. So I'm just carrying these right over from the adjusted trial balance column until I don't have any more balance sheet accounts left. All right, so those were the assets. Now I'm hitting the liabilities. So you'll want to be very familiar with the account types. So so I would go back and double, look at the how do we prepare financial statements part to help with that if you have not watched that video yet. And also consider reviewing from the earlier chapters if you aren't sure which accounts are assets, liabilities, or equity. Okay, so this withdrawal account is the last balance sheet account we have out here. And then after that, because that's a negative equity account, the equity they withdrew from the company. So now everything here from here down is revenues and expenses. They're usually the last half of your trial balance. So these ones get carried over into the income statement here, revenues and expenses. So that, and then these are all debit balances from here. All right, so with that, let's just double. So by the way, these, because we're breaking out some into income statement and some into balance sheet, these are not gonna be equal at this point, right? So we got to add these all up, and our debits and credits are not going to be equal in this subtotal right here, okay? All right, so that gets us to 65,000 here. And then we've only got the one revenue account, so we'll carry that down. Now, we've got revenues of 100,300, and then we've got expenses of 65,000. The difference between those two is actually our net income. So our net income is 35,300. We're going to pop that down here. And then if we add these together, there's nothing here. So 100, 300. Then our revenues and expenses columns here, our debits and credits are equal. All right, so the difference between our revenues and expenses is our net income. If we add our net income to our expenses, then it would be equal to our revenues. Now we're going to do the same thing over here. We're going to add up the debits and credits. And so for debits on the balance sheet, I have 149,000. And then for credits, I'm going to have $113,700. And let's see what the difference is between those. Oh, it's 35,300. So it's our net income, right? And the reason why is because we've got all these accounts over here. So this is actually the credit side of that. And if we add those together, we get 149,000 on both sides. Okay. And if we add, let's see here. So actually that gets us our worksheet. Now the next thing we need to do is we're going to take this and plug it into a financial statement. All right. So they're giving us first here our income statement. So we're going to go ahead and put this together using our numbers from up above. Now, the format that you're going to have on your income statement, again, always at the top, company name, the title of the financial statement, and then the time period that the financial statement is for, which is for the year ended December 31st of 24. And on an income statement, your first account is always going to be what? The thing that we typically want the most of and care the most about, which is revenues. And so we just have service revenues here. And the amount of service revenue we had was this 100,300 from this account. So we're just grabbing these end balances from the income statement columns here and plugging them in. Why we had. And then next, we've got the next section on an income statement is going to be your expenses. So we're going to list off these ones. So insurance, salaries, supplies. So insurance, salaries, supplies, and then we've got interest, rent, and depreciation. Okay, and so then our balance is 2,500, 45,000. Supplies, we've got, so 2,500, 5,500 here. And then rent and depreciation have 5,000 and 4,500. All right, so then we're going to have our total expenses. So we already know that our total expenses here added up to 65,000 because we added it up above. I don't know why it's giving me a random number here, but so then, and we've already calculated our net income of 35,300 up above as well. So we don't have to do any math here. We're just pulling this information down. All right, so that's our income statement. The next we're going to do is our statement of owner's equity. And the reason why is because if we just go straight to our balance sheet and enter in these balance sheet accounts, we see here it's going to be off, right? And the reason for that is because we haven't closed out our equity, our temporary accounts, into our owner capital account yet. So what ends up happening when we do those entries is we end up ultimately debiting service revenue to zero that account out and crediting it into capital long-term via the income summary account, which hopefully you have walked through the videos of what is the closing process and how do we close the accounts. There are 2 videos out there, which hopefully you've already watched. If not, now would be a good time to watch them. But we can also get the balances of our equity accounts at the end by completing a statement of owner's equity after we've figured out our net income. So we've got beginning capital here of 56,500 that was carried in from the prior year. And then And then to that, we're going to add in our net income for the year, which we just calculated and is 35,300. So if we take that beginning capital plus the net income for the year, that gets us a subtotal of 91,800. And then from that, we're going to subtract out those withdrawals that we made during the year. So less our owner withdrawal. So the 91,000 then 800 minus that 29,000 gets us ending at capital of 62,800. Okay. And once we have that, that ends up being what carries in as owner ending capital on our balance sheet, so that our balance sheet balances, because all of our, and we actually leave the, we leave this one zeroed out because we would have during our closing process closed this into our equity account. So I'm doing this a little out of order because normally you would do your closing entries here. But what we're going to do here is we're going to want to enter in on our balance sheet all of our assets, our liabilities, and our owner's equity. So take a second and look at the balance sheet accounts. They were nice enough to give us a little drop down so we don't have to keep scrolling back and forth here. So we're going to grab our assets here, which are so we're going to have first our current assets, which are the assets that are cash or expected to be converted to cash within 1 year. And those include cash, accounts receivable, because by the way, these are all listed in order of liquidity or how close they are to cash, right? And office supplies are something else we expect to use within 1 year, typically. So we're going to enter those balances in. And then that's going to get us to total current assets here, which we're going to add together. Of 92,000. So our first subclass on here on this classified balance sheet is current assets. So all of the assets that are cash or expected to be converted to cash within 1 year. We've got those all in there. Next, however, we're going to have our long-term assets, and we've got equipment, which falls under property, plant, and equipment. And so that's going to be our equipment account, less our accumulated depreciation equipment right there. It's just there. And accumulated depreciation equipment. That's going to get, so equipment less the accumulated depreciation equipment is going to get us to our total property, plant, and equipment. Which is 14,500. And then ultimately we add our current assets plus our property, plant, and equipment, or other long-term assets if there are any, to get our total assets. So 92,000 plus that 14,500 gets us 106,500. All right, so now that we've got that, I'm gonna slide this over here on this side so that we can see our, come on, move over a little more there, buddy. Yeah, there we go. So we can see our liabilities and equity side. So with liabilities, just like the assets, we're gonna have current liabilities. So liabilities that are expected to require us to use up our assets within 1 year. And then we can see there's a line here, which means the one after it is going to be our total current liabilities. So then we're just going to look here and say, all right, which of these liabilities are current and are going to require use of our assets or cash within 1 year? So we've got accounts payable because those typically get paid monthly. Salaries payable because people expect to get paid usually within a few weeks of working. Unearned revenue, if people pay us in advance, usually they're going to want to get their stuff within a year also. So we'll carry those balances in. So the video on preparation of financial statements would walk through those sub-classifications in a little bit more depth as far as what accounts are current, what are non-current, what are assets and liabilities. So please make sure to go through that video. Now, after our current liabilities, we have long-term liabilities. So liabilities that are not expected to be paid off within 1 year. And if we look here, we've got notes payable long-term, which is listed. And then after that, we've got capital. So that's our only long-term liability. So then because there's only one long-term liability, they're not going to have us do total long-term. They're just going to have us do total liabilities and then add together our current liabilities and our long-term note payable. And I got to get my total there for the current liabilities. So 13,000 plus 5,000 plus 4,700 gets us 22,700. And I'm going to take that and I'm going to add it to the 21,000 from my notes payable to get 43,700. Okay. All right. And then under owner's equity, we actually already calculated this up above. So when we click on this, it's going to show us that owner's equity that we did. So what we just want is that Farah's capital, which we closed out our owner withdrawals into for 62,800. And then if we add together our total liabilities and our total equity, so total liabilities of 43,700 plus the 62,800 in Farish capital, that gets us 106,500 for total liabilities and owner's equity, and that ties out to our balance on the asset side. So if our assets equal our liabilities plus our equity, we can be pretty sure that we got that number right. And we did. So that is that question. So now though, so we walked through putting this together using our worksheet, right? But we're going to walk through what would the closing journal entries look like to close out the temporary accounts into our capital account. So we're going to close out our revenues, we're going to close out our expenses, and we're going to close out that capital account here. So looking at that, they were nice enough, again, to give us the worksheet columns here so we can, I'm going to just make this wider. I don't need that Excel spreadsheet anymore right now. So scrolling down here, the first thing we're going to close out is going to be our revenue, which has so the right column here is credit, the left column is debit. So if this has a credit balance on the right, in order to close it out, I need to debit that for that whole balance. Service revenue, that's what I'm looking for. Debiting service revenue, and then we're going to credit that to a temporary account called income summary, right? And income summary, please watch that What is the Closing Process video if you have not yet, because you need to do that to understand why we're doing this. Basically, we just have this plug account income summary that we're going to shove all of our temporary account balances into in order to zero out all of our income statement accounts so that they're fresh and empty and ready to record income and revenue for the next financial statement period. All right, so to close revenue here. All right, and then our next entry, these expenses all have a debit balance, so we need to credit all of those. So we know that if we're crediting these, always our debit lines go first. and we're closing these again into that same income summary. So if we have to credit those, then that means we're going to have to debit income summary. And we have a total of 65,000 of those that we're going to have to close out from our worksheet. So we'll grab that number, and then we're just going to put all of these accounts here in order. So insurance expense, salaries expense, supplies expense, interest expense, rent expense, and depreciation expense. So, and we're going to credit those for whatever balance we have sitting in here. So and that entry is going to be to close our expenses. All right. And then the next thing I need to do here is close out my capital account. So we click on here and whoops, there we go. And then it gives us our worksheet with our, oops, we've got that. Oh, sorry, we need to close out our income summary account into capital. So our income summary account, by the way, so far, if we, let's see, where's my pencil? There we go. So income summary, I'm just going to label that. We have made an entry to this so far. We debited it for 65,000. And we credited it for the 100,300, which means if we net those against each other, we have a credit balance of 35,300. And this is going to get closed out into my equity account. So if it has a credit balance in it, to close it out, we would need to debit it. And then where that's going to go is into Farish Capital. Okay. And then, so that's going to be to close income summary. All right. And then last entry here, they're showing us the balance sheet columns where we can find our withdrawals. So there's a debit balance in the withdrawals, and we need to credit it in order to get rid of it. So that's going to be our credit value, is to offset this debit balance right here. And then that's again going to be closed into Farish Capital. So everything eventually gets piled into that Farish Capital account. Or if it's a corporation, they would use a company called retained earnings that you would close everything into at the end instead of owner capital. All right, so this one is to close withdrawals. All right, and then that was it. So that is a huge question right there. So I'm going to end this video with that one because this is such a long video, and then I'll start a new video for the rest of the problems here.